Hi, everyone. My name is Ila Dube, and I'm the co founder and CEO of EduFund. Today, we have a super exciting and esteemed speaker with us, Ms. Meeta Shetty, who is a seasoned fund manager at Tata Mutual Fund and an expert in the field of investment management. She has worked at reputable companies like Kotak Securities, HDFC Securities, AMSEC, and she also holds a CFA charter from the CFA Institute in the US and a bachelor's degree in economics. Today and together, we'll be discussing the recently launched Tata Innovation Fund. We'll delve into the fund's investment philosophy, its focus on different innovative sectors, and the role of emerging technologies in the Indian markets. All of this, of course, keeping in mind our lovely viewership and our audience of parents who I know are looking for different investment strategies and philosophies as they plan for their children's education and finances in the future. So, thank you for joining us today, Nita, and welcome.
Thank you, Ella. It's always a pleasure to do a session for EdFund and their families. I look forward for this, interactive session.
Likewise, let's jump right in. So, congratulations on the launch of the Tata Innovation Fund. We would love to learn more about the investment philosophy that you have, what kind of sectors and companies it's going to focus on, and of course, what will make this fund very unique compared to traditional equity funds.
So, this innovation category, when this was getting discussed at the very start and we were thinking about this product, the very first thought was that let us first define innovation. Because what happens is that when we heard the word innovation, you usually think of something which is probably gone through a deep research or a very high-end tech exotic kind of products, and then outcome of that is innovation. While of course that is an innovation, but innovation is much wider. It's much beyond these couple of things. And if you look around the things that are in terms of products or services which we use on a regular basis, they all have changed over a period of time, and most of them have gone through some kind of innovation in the way or form that they are coming to us today. So, we wanted to address this entire universe or ecosystem around innovation, and which is why we thought this was a very exciting idea to actually work on. The first level of thought for me was that let me first define innovation as to what exactly or where does it lie or where does it happen. So, it was three buckets that I could identify. First one was that it happens on the product level. Now, when I say product, anything from a bathing soap bar to all the way up to your Vande Bharat train experience goes through some kind of an innovation or has gone through a lot of innovations, right? Second was on the services side. Now, on the services side, your financial transactions, your food delivery, grocery delivery, your experience of travel, all of that has gone through a sea change. And all of that was led by some innovative thoughts, some innovations behind that. So, product and services were the first two buckets. And third, interestingly, was business models. Now, look, every business goes through some of the other challenges, and most businesses, to kind of, one, to tackle that, or two, to kind of never reach that point, have constantly innovated themselves with a lot of maybe business processes, business model changes, and that innovation gives a longer visibility to that business, gives a lot of stickiness to the customers, and a lot of other things in terms of your your margins, your efficiencies, etc. So third business model was the bucket where we could identify a lot of innovation. So product, services, and business model. That was the very first basic thought. Over that, we were thinking that innovations like the ones I spoke about, which go through a lot of deep research R&D, has a very long gestation period, are probably high risk, high return. We will have that as a part of our fund, but because it comes with a lot of risk reward, high risk and reward, we would limit it to a smaller portion, and we are calling that part of innovation as breakthrough innovation. So breakthrough innovation was a one which we want to have in the fund, but not too high. Maybe an exposure will be limited to maybe a 20 or 25 odd percentage, and the rest of the fund will be the gradual changes or innovations which keep happening on a day-to-day lives via product or services or even business models. And we are calling that piece of innovation as incremental innovation. So our fund will have a balance of both incremental and breakthrough innovation. So that is the basic thought of what we are thinking about this fund. As far as your question on philosophy goes, look, I am a bottom-up fund manager. I like to pick ideas based on stocks, and I don't take sectoral calls or market cap based calls. And that's my style, and that's what I prefer to do, and that's what I have been doing all these years. So this is exactly how I would be managing this fund. As far as the philosophy goes, look, Tata AMC stands for GARP, which is growth at reasonable price, and that's going to be the underlying for me to go and search for stocks. And that's what we usually try and do for all our funds, no matter what scheme are we talking about. So that's broadly on the fund and the style and the philosophy.
Typically, and history has shown that thematic funds often see higher risk due to their focus on high growth sectors and, of course, potentially higher reward as well. How are you thinking of managing risk, or how does this fund manage risk effectively?
Sure. So, well, I would say yes, a thematic fund would be on a higher riskometer versus, a diversified fund for that matter. But since this theme is going to touch across multiple sectors, it will be not very different. But however, I would say that on the riskometer, probably a sectoral fund comes on the higher side, wherein the limitations are extremely very, very narrow for a fund manager to go and invest and search for ideas. For example, the Tata Digital India Fund, which is an IT sector fund, which will probably invest a lot more in Gen AI because it's an IT sector fund and it will have a higher exposure probably to that area. But at the same time, because it's only that one sector, whenever there are sharp cycles in any sector, which usually we see sectors do go through cycles, then my limitation over there is very, very less in terms of how I can maneuver through that cycles of that particular sector. But coming to innovation fund, this fund, as I said, will have a decent broad presence in across, say, banks, on consumption side, on the platform stories across fintechs and consumer or health, etc. Even on areas like, say, chemical, where you are seeing a lot of green chemistry, or say on the power side where there's so much renewables happening. So it will have a very broad based universe for me to choose and pick. So I would say yes, as a thematic fund the risk will be higher, but because I'll be able to go through so many sectors to choose and pick my ideas, it would be better than any sectoral fund.
Fair. It sounds like the balance will help control and manage the risk effectively, which is great to hear. Coming to, I think, something that has been the elephant in many rooms is the market correction, right? We've watched Nifty dip from its peak of 26,000 to roughly 24,000. What is your thought on the markets going forward? Do you think this is a temporary correction, or this could be a potentially longer trend that we should prepare for?
Okay. Look at about 26,000 plus levels that we were trading at. The valuations for Nifty, I would say broader markets rather, was around 23 times or so. 1 year forward, I would say, or rather 2 year forward actually. And now that we've corrected, we are closer to about 19.5, 20 times kind of valuation. So I would say yes, we are better off than where we were in terms of our attractiveness, but we should be in a more comfortable zone for us to start getting very excited for the next leg of momentum or rally, I would say. So my sense is, and what we are picking is that probably we will go into some kind of consolidation for at least a couple of quarters. That is what is the thought broadly. And if you look back in the last 5 years, we've had a year and a half kind of consolidation in the market, which was from October 21 to March 23, where markets just languished in a very narrow zone, but then it created a good base. The valuation started looking attractive again with about 18 and a half times kind of multiple, and then we were set for a next leg of rally. I think something similar most likely will unfold over the next couple of quarters.
Do you think a SIP is appropriate for this fund, and would be suitable for families like ours that are thinking long term?
Yes. So I would say that if you are, and you should, rather any equity investment, that you should have a 3 to 5 year kind of horizon. If you're comfortable with that, and since this is an NFO, it gives you a good head start. So even if you want to, park a decent sum at once and then continue with an SIP is what something we would recommend, since we've seen some 8 to 10% drawdown in the markets already, and next couple of quarters would give us a good base to enter at a level where we would see some consolidation and we would be able to identify some opportunities at a reasonable level in terms of valuations. So yes, I would say that since it's an NFO, it's better to start with a decent size and then top it up with a regular SIP.
What is ideal level of exposure to equities or high growth sectors and one's portfolio, considering the current market climate?
Sure. So I think, look, there's no one answer to this, because every individual, even in the same age group, will have a very different risk profile. So I think that for me to give you one answer, it's not the right thing. But I'm sure, partners like you and advisors like EdFund will definitely do a great job in that, and will help them evaluate at an individual level as to how much risk they can take. But I would say that limit your overall exposure to the sectorals, especially in very narrow themes, which are very bounded by where they can invest. Small allocation to that is always warranted, and have a pretty balanced capital allocation depending on your risk profile.
My last and final question for you today is, what advice would you give to an investor, whether they're new or have invested before, on understanding and navigating today's market?
I believe that this is the best time to be, a part of this growth of our country and stay invested via equity. Or if you're not investing, definitely take some share of this growth, benefit from this share of growth by investing into the equity markets. Of course, based on your risk profile, for sure.
Thank you so much for that, wonderful conversation. It was really nice to have your time, learn more about the fund, and I wish you much success with the NFO and the fund in general.
Thank you so much. Thank you. It was a pleasure connecting.